Good morning and welcome back to Margin. This morning, we're going to talk about the types of mortgages and which one is actually right for you. So let's jump right into it. So once you determine whether you are ready to buy a home from the standpoint of the minimum bank or lending institution and their standards or their requirements, you will then need to determine which mortgage you will be considering. Now, according to Rocket Mortgage, all types of mortgages are considered either conforming or non-conforming loans. Now, conforming versus non-conforming loans are determined by whether or not your lender actually keeps the loan and collects the payments and the interest on it, or sells it to one of two real estate investment companies, either Fannie Mae or Freddie Mac. In an article written by Rocket Mortgage, they outlined the various types of mortgages along with the pros and cons, and defined each by either being conforming or non-conforming. So they stated that a conforming loan is one that can be purchased by Fannie Mae or Freddie Mac, as I mentioned before. So within this, there are a few requirements in order for the loan to qualify as a conforming loan. So you'll want to go through those requirements and make sure that you actually hit those to ensure that you can get a conforming loan. But fortunately, your loan provider, your lender, will actually go through those and make sure you qualify. So you may have heard of a conventional fixed rate or adjustable rate mortgage, which all fall under conforming loan requirements. On the contrary, though, non-conforming loans are those that do not qualify. So according to Rocket, most non-conforming loans will be government-backed loans or jumbo loans. So within the conforming category, the first mortgage type and most common is a conventional mortgage. So these loans have lower requirements around income and type of home, but do have greater restrictions around the debt to income and credit score ratios that you need to have. So a fixed rate mortgage is a mortgage that locks you in at a certain rate for the life of the loan. So most people go with this because they know what to expect on a normal monthly basis. So you could lock in, let's say, a rate for a 10-year, 15 or 30-year accordingly. And typically the longer the duration of the loan, the better the interest rate. Now, there is a lot of talk around a 40-year mortgage becoming a thing, and especially as affordability for housing has become more and more difficult, and for most Americans is now out of sight. But we will see what happens in the coming months, the coming years, and whether this truly does gain momentum or not. Now, an adjustable rate mortgage, otherwise known as an ARM, has an introductory rate that then adjusts and escalates based on the market conditions. Now, this can be helpful initially to lower the monthly payment, but even with rate increases in place, it can cause inconsistencies in your monthly payment over the life of your loan, making it kind of difficult to factor it into a plan to spend or a budget accordingly. An example of this would be a 5-1, and it's a mortgage that would have a fixed rate for the first 5 years, then would basically adjust thereafter according to the market conditions. Within the non-conforming category, the first mortgage type is an FHA mortgage. So these are actually insured by the Federal Housing Administration. So FHA loans are typically more accessible than conventional loans due to being more lenient in the credit rating requirements. And so the next loan type is a USDA mortgage. It's insured by the United States Department of Agriculture and is for buyers purchasing in rural or even suburban areas. So the property type has to actually come into play. It actually has to fit into the mold of what would be required by by them. And so with this type of mortgage, only certain properties will actually qualify. So my brother actually purchased a home in a rapidly growing area on the East Coast. And although this home was centrally located, because of the rapid growth, it was actually able to qualify for a USDA mortgage, which came with a ton of perks. Not only a better rate, but it also had a number of other things that actually benefited him and his wife when they closed on the home. So the next mortgage type is a VA mortgage. It's insured by the Department of Veteran Affairs and has a minimum service requirement for the armed services. Now, being in a family with a number of military veterans, I know multiple family members who have actually utilized this. However, it's really important to make sure to compare rates to ensure that the VA fees and interest rate do not make the lower down payment requirements for the VA loan less attractive. And so you'll want to compare rates accordingly. So a jumbo loan is a loan amount that is above a certain threshold, which carries higher minimum qualifications and requirements set forth by the lender. Now, oftentimes these jumbo loans are north of somewhere around $548,000, depending on your area. So you will only qualify for a jumbo loan if your home purchase minus your down payment sits above that threshold that's specified for your specific area. Now, balloon mortgages are those that are the least popular, especially post-recession. So these mortgages have lower requirements to qualify, as well as typically lower interest rates and resulting payments, but have a large sum due at a certain point in time that puts both the lender and the borrower at higher risk for that loan type. So during the Great Recession, there were a number of other non-conforming loans like interest only or ninja loans, if you remember those. So those were no income, no job, no asset loans that people were getting loans if they had a pulse. Now, there was a lot of other creative products created during that time that we see a lot less of due to regulation. But it's important for you to actually know, okay, what's available to you and what is actually wise to pursue and what may be troublesome. So a reverse mortgage is a way to capture or unwind the equity built in your home if you're over the age of 62. Now, this provides an income source for someone who may be on a fixed income and maybe has a lot of their net worth tied up in their home, and it is inaccessible without a HELOC, a home equity loan, or selling the home and moving. For many of these loans, there will be a requirement of PMI or private mortgage insurance. You probably heard this a lot because this was something that was mainly put into place after the Great Recession and the regulatory aspects that came after that point. But the private mortgage insurance is typically attached to the monthly payment at a percentage of the total outstanding loan debt. So for some loans, this PMI will remain for the life of the loan, while others will basically either allow you to remove it or it will drop off naturally as the value hits a certain figure. Now, in order for you to avoid PMI, most providers require at least 20% down. Now, with each of these loan types, there will be varying degrees of requirements, but generally speaking, you will want to avoid creative loans, ones that promise lower interest rates or payments due to a balloon payment, being interest only or being adjustable. Now, if you need to get a home loan, then looking into a fixed rate conventional mortgage is typically the best route if you qualify. So my call to action today is to do your research before finding that house. So many may or may not even get pre-qualified before finding the home of their dreams to pursue. But make sure to not only get pre-qualified, but to actually go through the process of finding the mortgage type that works best for you and your situation. If this information is helpful to you, please do like, subscribe, and hit the notification bell so you're reminded to come back on a daily basis and improve in managing your personal finances. Thank you for your time. Enjoy your day, and we'll see you back here tomorrow.